friends, this is Sahas Academy. We are presenting India Macro Market Analysis. It covers global and India-centric events impacting currencies, interest rates, equities and gold. So, let's begin with episode 2. Let's begin first with global macro news and events. On the US debt ceiling front, the Congress has passed the bill to enhance the debt ceiling limit for 2 years. This has removed the risk of default. The bill suspends the debt ceiling through 1st January 2025 in exchange for enforceable spending caps over the next 2 years. As per projections by Congressional Budget Office, spending cap would result into saving of $245 billion. Additionally, since the caps are effectively a downward level shift for government spending, the Congressional Budget Office estimates that the total deficit reduction could amount to $1.5 trillion over a 10-year period. Odds for the rate hike expectation in US was increased after the bill was passed to enhance debt ceiling limit. However, mixed macroeconomic data with initial sign of labor market cooling, as unemployment rate has increased despite strong non-farm payroll data, will put the Fed on wait and watch mode. Further, the dovish comments from Governor Jefferson and Philadelphia Fed President Harker put a lid to such expectations, as both emphasized that the Fed could skip a meeting. However, Jefferson stated that policy rate constant at a coming meeting should not be interpreted to mean that we have reached the peak rate for this cycle. Macro data from China, which shows weakening momentum in its manufacturing sector and less than expected pickup in consumer spending. The official manufacturing PMI showed a deeper contraction in factory activity in May, as the headline PMI index fell to a 5-month low of 48.8 from 49.2 in April. China Caixin PMI shows May factory activity swings to mild expansion. The index came in at 50.9 for May, up from 49.5 in April. Mixed survey results indicate China recovery is still uncertain. Eurozone and UK's macroeconomic data continue to show weakness. Downward revision to Germany's GDP to -0.3% for the Q1 for the year 2023 versus -0.5% in Q4 for the year 2022 has reignited fears of global growth slowdown on account of elevated prices and aggressive tightening by central banks. S&P Eurozone manufacturing PMI fell to 44.8 in May from 45.8 in the previous month. UK's manufacturing PMI fell to 47.1 in May from 47.8 in the previous month. Eurozone CPI estimates fell to 6.1% year-on-year in May from 7% year-on-year in the previous month. Lagarde says Eurozone inflation still too high. ECB will hike rates but not as rapidly. Villeroy says upcoming rate hikes will be marginal. BOJ Governor Kazuo Ueda said, global central banks may already be facing a new economic environment where inflation will no longer revert to the low levels of the past. He added, it may be difficult to deny the possibility that we are already in a new normal that is different from the period of low inflation for long. The BRICS nations stressed on using local currencies in international trade. The nations bloc also committed to support rule-based open and transparent global trade. A joint statement issued at the end of the meeting of the BRICS Ministers of Foreign Affairs and International Relations also pressed for a robust global financial safety net with a quota-based and adequately resourced IMF at its center. Now, let's move to the next section, India news and events. India's GDP growth was surprised upside. In fourth quarter of financial year 2023, economy clocked GDP growth of 6.1%, supported by investments and net exports while private consumption remained weak. For the financial year 2023, GDP also surprised upside. The GDP rose by 7.2% in financial year 2023. Higher than anticipated GDP was on the back of strong growth led by agriculture, trade and transport sector. The centre's fiscal deficit narrowed to 6.4% of the GDP in financial year 2023 from 6.71% in financial year 2022. During the year, direct taxes grew by 18%, while indirect taxes grew at a lower rate of 7% year-on-year. GST witnessed a robust growth of 21.6% year-on-year in financial year 2023. Market expects status quo in the 8th June's MPC meet, as inflation is on downward trajectory, though it is still on higher side of tolerance band. Since inflation is on downward trajectory with global commodity and crude prices are also softening, it gives room to RBI to wait for further data before taking any policy action. Better than expected GDP in fourth quarter of financial year 2023 has given space to RBI to wait for more data to provide any monetary policy support to growth. The GDP growth is driven by investments rather by consumption, hence it will be less inflationary. Total bank credit growth stands at 15.9% year-on-year in April 2023, with non-food credit growth up by 16.1% year-on-year and 1.3% month-on-month, with growth being driven by services and agriculture segments, while retail month-on-month growth was a tad slow. We may see some moderation in credit growth due to 250 bps steep rate hikes by the RBI in the last 12 months. India's manufacturing sector continues to grow stronger as data showed that factory output expanded at the quickest pace in the last 31 months. The S&P Global India PMI manufacturing rose to 58.7 in May from April's 57.2. The strongest level since October 2020. As per RBI's annual report, on the back of sound macroeconomic policies and softer commodity prices, India's growth momentum is likely to be sustained in FY24. However, slowing global growth and geopolitical tension may pose downside risks to growth. India's total goods and services tax collections in May moderated to 1.57 trillion Indian rupees from the record high of 1.87 trillion Indian rupees in April. As per provisional data published by the RBI, India's services exports in April rose by 7.5% year-on-year to $25.8 billion, while imports recorded a 3.1% decline to $13.6 billion. The Indian Meteorological Department stuck to its forecast of a normal monsoon for this year at 96% of long-period average, as it released the second long-range outlook on Friday. As per the department, the adverse impact of likely El Niño conditions will be offset by positive Indian Ocean Dipole, a measure of Indian Ocean surface temperature. However, most parts of the country will witness deficient showers in June, except some pockets in peninsular regions. Sanjay Budhia, chairman of the CII Committee on EXIM, stated that economic recession in Germany is likely to impact India's exports from various sectors like chemicals, machinery, apparel, and electronics to the European nations. As per periodic labor force survey released by the government, urban unemployment during fourth quarter of financial year 2023 declined further to 6.8% from 7.2% in third quarter of financial year 2023, owing to a better than expected economic activity and a strong services sector-led growth during the quarter. Now, let's move to our next segment, market analysis. Let's first start with analysis of USD-INR price move. During the week, USD-INR prices were tracking movement in dollar index. It moved in the band of 82.26 to 82.78 and closed the week at 82.39. During the week, in daily chart, the currency pair broke the 82.38 support, but it closed the week at above support levels. Technically, the currency pair is expected to move in the band of 81.85 to 82.90. As the risk of default abated with passage of the debt ceiling limit and mixed data from US, may refrain Fed to continue with rate hike action, which led to reversal in dollar strength. Dollar index closed the week at 104.01 from its previous week's close of 104.21. Though risk of default of US Treasuries has been abated, market is concerned about the risk of Treasuries growing auction, which will keep dollar index elevated. It is estimated that US Treasury auction size will be $500 billion over the period of 12 months. This will lead to reduction in liquidity in the banking system and put upward pressure on the dollar index. It may also lead to rise in treasury yields and also impact emerging market equities negatively and put upward pressure on the USD-INR currency pair. But on the other hand, India's external balance has improved in recent months. Any sharp INR appreciation is unlikely, despite weakness in dollar index, as RBI is biased towards accumulating USDs. Whereas in the event of dollar strength, we may see INR outperforming, as RBI will continue to intervene to curb volatility and sharp upmove in the currency pair. We have seen some upmove in the commodity and crude prices at the end of the week. However, the trend will continue to be on downward trajectory due to global growth concerns. Low commodity and crude prices are supportive to India's fundamentals and Indian rupee. US monthly oil data for March 2023 show the highest historical monthly level of total liquids supply and a record level of gross exports of crude oil and petroleum products, which may force OPEC Plus to cut supplies to support prices in the market. However, lagging demand in the three largest economies in the world, the US, China and the European Union, and buildup of inventory globally, will keep a tab on any sharp upmove in the crude prices. Now, let's analyze gold-dollar price move. Market opened the week at 1943. After taking channel support at 1930 zone, the prices touched a weekly high of 1983. The price move was tracking movement in dollar index. The weekly chart indicating further correction in gold prices. In our view, gold will take a support at 1915 zone on weekly basis. In daily chart, 1930 is a support zone which was well respected last week. Back to India market, gold demand is back at the lower prices. Gold demand has also picked up due to 2000 rupees note ban in India. At lower levels, jewelers are restocking their inventories. In the light of 2000 rupees note ban, banks in India are also refraining from doing cash business with new customers to avoid later wrath from RBI. Banks have similar experience in 2016 during the demonetization of high currency value notes. Some part of cash is chasing high value items including gold. Now, let's analyze equity price move. This week was full of data. There has been several positive news in the week that has gone by. The GDP data for financial year 2023 surprised upside at 7.2%. May GST collection has recorded 12% increase year-on-year. The S&P Global's India Manufacturing Purchasing Managers Index, PMI, surged to a 31-month high of 58.7 in May, with factory orders rising at the fastest clip since January 2021, and producers accumulating inputs at an unprecedented pace. UPI transaction reported a new all-time high at 14.3 trillion Indian rupees. On the consumption side, the automobile industry reported highest ever May monthly dispatches of 334,802 vehicles. To top it all, the liquidity surplus in the banking system has reached 2.4 trillion rupees by 1st June as reported by the RBI. This surplus liquidity is on the back of government spending, FX flows, 2000 rupees note ban and transfer of dividend by RBI to the government. The surplus liquidity in the system has cooled off the overnight money market rates. Although Nifty 50 ended the week with a small bearish red candle, it is very much within the rising channel. As long as Nifty remains in that rising channel in the weekly chart and closes above 18,450, which is 78.6% Fibonacci retracement, one has to make all trading strategies considering the market is long. Option open interest data clearly indicates that the market is centered around 18,500 to 18,600 zone. Drop in India VIX has reduced the option prices significantly. In this scenario, option buyers are at an advantage over option sellers. In spite of many chartists predicting a correction in Nifty, Nifty seems to be defying everybody and rising. We feel, because of so many positive developments in Indian economy as mentioned above, any major correction in Nifty in near future is highly unlikely. Unlike Nifty, Bank Nifty seems to be breaking down from its rising channel in the weekly chart. It has retraced 100% of the previous all-time high and is looking as if it lost the vigor. A correction in Bank Nifty is highly possible and looks like happening in next few days or weeks. The latest weekly candle of Bank Nifty has broken the lower boundary of the channel and closed below it. We feel that if Nifty has to maintain its upmove and Bank Nifty is showing weakness, then other major sectors have to do well, and that includes IT, FMCG, auto and energy sectors. Nifty IT looks most promising at this point of time. It has gone through a prolonged correction and consolidation. If IT along with FMCG, auto and other industries take the mantle from Bank Nifty, then Nifty's march ahead will continue. Now, let's analyze the bond price move. During the week, 10-year India government security traded in a very narrow range of 6.96 to 7.03 levels. Market is at consensus that in the next week's MPC meet, the policy rates will remain unchanged. Comfortable liquidity in the banking system will keep a lid on any sharp up move in the yields. We believe that, in the near term, bond market will continue to be supportive with the global monetary tightening cycle is near to peak, domestic inflation on downward trajectory along with soft global commodity and crude prices, and likely pause by the RBI MPC through financial year 2024. However, risks remain from weak monsoons and consequent food price inflation and geopolitical uncertainties. U.S. Treasuries rallied as risk of default is abated. The rally got further support with the early signs of labor market cooling off and subdued data print on manufacturing PMI, which was contracted. Here we wrap our discussion. Thank you for watching the video. If you have any suggestion or feedback, you can reach us at info@sahasacademy.com or visit our website www.sahasacademy.com. You can also reach us through social media platform LinkedIn, Facebook, Twitter and Instagram. To encourage us to share more videos, please subscribe to our channel. Thank you. Disclaimer: this video is made for educational purposes. It does not constitute an advice. Please consult with your investment advisor before taking any investment decision.